Guys, it's July 13, and you may be asking yourself right now, why, oh why, did the stock market not crash today? And our portfolios were actually positive when we received the worst inflation read in 41 years from Consumer Price Index earlier today in the morning. Okay, we're going to go over that question. I want to explore it a little bit in depth. It's a little bit of what we talked about in the past, but I want to hit this and reinforce a very important issue here, okay? Before we get started, of course, please hit that like button, hit subscribe. Hopefully you learn something from these videos, and we have some fun in the meantime, okay? Let's get to it. Okay, so here is the markets for today. This is today's action. We'll start with the Dow Jones, down 0.67%. That's pretty mild. The S&P down about 0.5%. NASDAQ only down 0.15, an outperformer on the day. Tech is the outperformer. Weird. I wonder why. Okay, and the Russell 2K, another outperformer. These are your small cap value stocks mostly. Again, 0.12% to the downside. Not much. The VIX volatility index is down, which is a good thing. And then, of course, the U.S. 10-year, very interestingly, under a 3 handle. Interesting. And oil under $100 a barrel. So very interesting action. Again, here I want to point out my boy Jerome Powell. If you do not know who this is and you're invested in the stock market, you need to find out who this man is and how he affects your portfolio and affects your daily life. Okay, you cannot afford to not know who this guy is and be invested in the stock market. Okay, let's move on. So here's the horrible data today from Consumer Price Index. The year-over-year inflation, 9.1% versus the street's expectations of 8.8%. It's a hot read, guys, very hot read. Core CPI, that's excluding energy and food, whatever, 5.9% versus 5.6%, hot as well. And the month-over-month CPI, 1.3 to 1.1, very hot as well. So this is a horrible, ugly number, okay? But what we have to know, the reason why stocks only moved just marginally to the downside is because of several reasons. Let's go over those reasons right now. And the first thing I want to show you is a chart of the NASDAQ. This is, of course, a 5-year chart of the NASDAQ composite. Again, the NASDAQ composite is mostly made up of tech stocks. These are more volatile stocks that trade at higher premiums to the stocks in the Dow or the S&P. If you can see here, this action on the NASDAQ has been horrendous this year. You see this decrease right here from July 2022 to the first half of this year has been absolutely horrendous, from about maybe this looks like November 2021 to 2022 and on. It pretty much peaked right here in late 2021 and just been nothing but devastation and straight down throughout. So the first point of this chart is essentially did this downturn here in the NASDAQ, about a 30%, probably maybe closer to 32% downturn on the NASDAQ, did that price in a bad news story, like a bad CPI for month after month after month? And the answer is yes. The market is telling you, yes, this is largely priced in to the stock. This CPI read from June, largely priced in, but that's not the biggest reason it didn't move today. The biggest reason that stocks did not move to the downside heavy today is because the markets look forward, not behind, right? So when we're investing in stocks, we're not saying, oh, well, Disney did this 6 months ago and the Obi-Wan show, a month ago was really good, so they should be doing really great. No. Stocks always, and the market always looks forward. It never looks behind. You probably heard the saying of, it doesn't matter where stock's been, it matters only where it's going. So I'm showing you guys here this Horizon Kinetics Inflation Beneficiaries ETF, symbol INFL, like inflation. Okay, so when we're talking about inflation beneficiaries, this ETF, which is a basket of stocks, is made up of companies that are the beneficiaries of inflation. So we can see here, it peaked somewhere here in May of this year at its high. We're looking at a 1-year chart of the inflation ETF, inflation beneficiaries ETF, and we see here that since the peak, it's pretty much gone down, right? This is June 6th right here. This is a little bit more than a month ago. This is about what, 6 weeks ago, 5-6 weeks ago. It hit 32.67 somewhere on this, and now it's at 28.26. Okay, these hedge funds and Wall Street is not selling the inflation beneficiary ETF because they think inflation is getting worse. Quite the opposite. They're looking forward, they're looking at the data, and they're saying, hey, inflation has likely peaked, which is what I believe very, very strongly. It's the reason that I've been buying stocks heavily this summer. You guys have seen my buys. I've only sold one stock, that's Dutch Bros, for a 50% profit because it got away from me. And, you know, a bird in the hand is worth more than you know what, okay? So when these guys are selling, when the hedge funds and Wall Street is selling the inflation beneficiary ETF, they're not saying inflation is getting worse. They're saying it's going to get better. These companies are going to benefit less and less and less every time from inflation. So we're going to sell this ETF. And what they're looking at, of course, is the data, the state of the war against inflation. I kind of moved this slide here from another video I did previously to kind of update it because inflation is fluid and it moves fast, a lot faster than you would think. So we have trends in inflation, guys, right? We have the retail inflation, which is a positive trend. We've seen Target, Walmart, now Kohl's, Bed Bath & Beyond. We've seen Gap, we've seen American Eagles telling us that there's a glut of inventory. For Gap and American Eagle, it's a glut in apparel. Too much inventory in their warehouses, which equates to sales and lower prices. So retail inflation is a positive, it's a positive trend, and it will be going down starting from now on after this report, starting July and throughout the rest of the year. Okay, then we have the commodities inflation. Okay, let me show you guys here another chart real quick for commodities. And I want to show you the DBC, which is commodities tracking ETF. And it sort of follows the same pattern as the inflation beneficiary ETF, right? We see here probably around May, April, May, hit its peak, and then all of a sudden goes down, okay? We're talking oil, we're talking grains, we're talking metals. It's measuring all kinds of commodities, and it's being sold by the market. Why? Because they expect cheaper prices for these products, which is deflationary by nature. So another reason to believe that inflation has peaked. Now, something more sticky, and I think one of the stickier points of inflation, and I honestly have no idea how this is going to get fixed other than massive layoffs, and it's wage inflation. Because when people are used to getting paid a certain number, a certain dollar amount, it's very hard for them to settle for less in the future, okay? We still have more jobs than people looking for jobs, almost at a 2-to-1 ratio. That, I think, has been unheard. I've never seen that before in my life. I think there's people that are alive that have never seen that before in their lives, but that is the case. To correct that, we need automation. The pace of automation is slow. It takes many, many years to automate something so more people can be free to do other jobs, okay? And of course, the job market is robust. There's just no other way to put it. The job market is still good, okay? When it comes to housing and rent, there's a little bit of a change on housing and rent because the CPI did show that rental properties are still stubbornly high, maybe even heading higher than previously thought. So this is something that's going to have to be addressed. Maybe each state can address their rental property issues, kind of like California has with a cap on rent. But at the same time, it's like, who's that fair to? Is that fair to landlords? Maybe landlords are making up for all the months that they weren't getting paid while the lockdowns were happening. I'm sure if you know me, being a landlord is something I will never do. I will never be a landlord ever in my life. I just refuse to do it, okay? And imagine being a landlord during the lockdowns and not being able to evict somebody because they're not paying you and they're just living there for free month after month after month. And then all of a sudden they have to pay you and they just leave for somewhere else. That's, of course, not happening now, but I can totally understand renters charging a higher fee to try to make up some differences from when the lockdowns were happening, okay? So when it comes to normal housing, right, we have increasing inventory because of those higher rates and the lowest home sales in decades, which is deflationary by nature. If you look around your neighborhood, if you look around, your city, and you Zillow your home, you're going to see your home probably worth less today than what it was 2-3 months ago by about 25-30%. That is deflationary, okay? We talked about speculation. Very positive on the speculation front. I love the speculation front that the IPO window is shut. Companies are not hating the market at the same pace they were in 2021 and in 2020, okay? NFTs and cryptos are dead, okay? Right now, they're just no good, no bueno. Cryptos are just the house of pain, and all the crypto bros, sorry guys, it's not working out. Doesn't mean it won't work out in the future. That's the risk you have to take. But if you look at a company like Voyager Digital, look at Voyager Digital. That's a bullet that I dodged because I was invested in that for a little bit as a trade. I made some money on that trade. Not a lot of money, but I made some money on that trade. But at the same time, I'm not down 99% on my position. So dodge that bullet. Okay. And then, of course, the Wall Street Bets crowd. Bless you guys. Okay. You guys are still stuck with AMC and GameStop. It's kind of landlocked there, and you're not expanding anywhere else, which I'm totally okay with. Okay. Now, with energy inflation, which is a new category that I added here, the trend is positive. We can see here WTI crude hitting its highs in June, given the high CPI report, right? So the CPI report is capturing the price of oil at about this rate. Here, after that, it's gone pretty much straight off a cliff. If you look at the chart, at a 1-year chart, okay? For these prices to catch to the pump, it's about maybe 2 weeks for prices to catch up. So hopefully this trend continues. Hopefully with China and lockdowns again, the price of gas should come down a little bit more. Hopefully we see it under 90 sometime soon. That would be great. We'll see, okay? I don't know what's going to do. But, of course, with other stuff here, we talk about supply chain onshoring. I've heard that word a couple of times in the last couple of weeks, supply chain onshoring. And that's the government trying to facilitate the building of semiconductor plants and factories and more manufacturing in the U.S. That's positive. That takes a lot of time. So we're also talking about oil refineries. Oil refineries take like 3 years to build. So that's a long-term thing. Deflationary, yes, but very much long-term. Semiconductors for cars, I don't know if that's a positive or negative yet. We have to wait tomorrow, and I'll be up tomorrow in the morning to see Taiwan Semi report their earnings in the morning. If you want to get up with me, join us in the Discord chat, more than welcome, okay? And then China lockdowns, again, we've been over that. These guys just keep locking down. Remember that zero tolerance policy. One person goes positive, the whole region gets in lockdown. We also have Ukraine and Russia still going on. Hopefully we see a resolution to that soon. And Amazon Prime Day. I think Amazon Prime Day is huge in this country. Huge. And as deflationary as it can get. When people get good deals and they buy all the things that they want for the year in July at an extreme discount, that is deflationary by nature. And it only helps Target, Walmart, and Kohl's, who were already over inventory, even discount their prices even more to move them out for new inventory, okay? Now, we'll talk about what happens now, okay? And then what happens now to the Federal Reserve is faced with a couple of choices here, okay? The more likely choice is the 75 to 100 basis point interest rate increase in 2 weeks' time. I think they're going to go 75. I heard a lot of talk today about 100. I think that's kind of extreme because it is a huge increase to the base interest rate. I think it's more likely to go 75. I think there's a couple of Fed members of the government chairs that will vote for a more tame approach, a longer tame approach rather than a more aggressive, steeper approach. But who knows? I think it'll be either 75 or 100. I'm okay with either, really, okay? And we have two options that are dependent on the data that comes out for further CPIs in July and August, okay? So the bearish case is more rate hikes because inflation keeps being stubborn, okay? I don't think that's the case. I think inflation will continue for the rest of the year to surprise to the downside. Of course, if nothing else happens globally or some crazy macro event happens, then that would change the theory altogether. But if things stay the same, more rate hikes at later Fed meetings and more aggressive ones, I think is more unlikely. The bullish case, the bull case, is we've done enough to control the situation and to maintain rates or to even decrease rates to steady the rate of deflation and to make sure it comes down to an acceptable level in which it can just coast down back to the 2% target. Okay, we're way off that 2% target, but if we start in July going to 7 and then 6 and then 5, I can see the Federal Reserve saying we've done enough. We can maintain rates for a while or even consider rate decreases. And let me tell you what, you want to be long the market if this happens. This is just a matter of time, in my opinion. So from now on until this happens, you have all the time in the world to get invested if you're not already, or to add to your positions, or to complete your portfolio to your satisfaction, okay? My portfolio is pretty much complete. Anything else that I get to buy at a discount is gravy, cherry on top. But until this happens, this is the day when all the longs, people like myself, we're going to be jumping up and down because the market will flip like this and we're going higher, okay? Now, just to kind of go over this again, what am I doing? I'm a net buyer of stocks. I'm not focused on instant gratification. I want to kind of just hit this a little bit quick here. Instant gratification. When you buy a stock, no matter if you're adding to your position, if it's a new position, you cannot expect to be instantly gratified on your purchase, okay? If you buy shares of Dutch Bros and they go down by 1% or 2% over the next couple of weeks or even 5% over a month, do not expect to be up on those shares as soon as you buy them. Do not expect instant gratification in 2022. Do not expect that. Expect that later in 2023 when we reach that bull case. And once we reach that, which I think we will, okay? And that means we stay focused on the long term, okay? We're buying when the market pukes, not when it rips higher, okay? Once it rips higher and that bull case comes out, you're too late. You're too late to the market. You're chasing the market now, and you're too late, okay? You have to be paying attention to earnings also, especially Taiwan Semiconductor tomorrow morning, okay? And this is going to tell you what's going to happen with cars and the semiconductor supply chain, which matters for cars, for used cars, and the whole car industry, okay? Not to mention high-performance computing, data center, etc., gaming even, okay? So that's it for tonight, guys. Let me know if you guys have any questions. I'd be happy to help you. Hit me up on the Discord, Instagram, Twitter. Let me know if I can do anything for you guys. Peace out.